Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, March 3rd, 2023. S&P 500 is currently sitting at 4032. I'm David Zarling. I'm here with a man that agrees that sweet tea is not so sweet, Ian McMillan. Can you believe that 2 months are gone already in 2023?
2 months.
Just like that.
It's been a busy start to the year.
Time flies. And maybe it's just because, is it because February's got 28 days? I don't know.
I think it's got to have something to do with it.
But we got 2 out of 12 done. We've got a February that was negative in the market. January was positive as a reminder to our listeners. And January was, we look at January barometer, first 5 days were positive. Santa Claus rally was positive. So jumping right into it, seasonality wise, you had a trifecta that tends to signal that there's strength in the market. We could see seasonality be strong this year. It's a pre-election year or post-midterm year, depending on how you want to describe it on the presidential cycle, which is also a positive. But here we had a February that was negative.
February is negative, flat for the first half of the month. Then seasonality, I guess, kind of did what it always expected it to do. Second half of the month, February,
Good point.
Down, and
you're just saying that from a seasonal perspective, mid-February through the end of February is typically negative. And
so yes, February is typically negative, and then a majority of that it comes in the last 2 weeks. And kind of buyers, we come back down to some important support areas over the last few days, the last week. IWM down to its November highs, and right there around like 187, 188. And you had the Qs come back down to their November, December highs around 290, also 200-day moving average. And you had S&P. It is still below its November highs, but did come down to its 200-day moving average. And so far, we have seen some follow through off that. Now, granted, it's only 2 days.
But it's a good sign for a thesis, right? If above a 200-day is better than below a 200-day, which is a simple argument to make.
Yeah.
Anytime price is exceeding the prior 200 days of information averaged, it's probably a good thing from a bullish perspective.
And we should start to see, correct me if I'm wrong, Dave, we should start to see most of these moving averages turn up.
Yeah, we should start to see some moving averages at minimum continue to flatten out or start to turn up. And the reason why we can even say something like that is all a 200-day moving average is a math problem looking back 200 trading days in the past, which happens to be, as of today, approximately mid-May. And mid-May going forward is a 20% range. And so some of the data, a 20% range, and it's sideways. So at minimum, 200 days are going to start flattening out. But as we move forward in time, some of the what I would call data that would drag the average down is starting to fall off. We could start to see the 200 days start to move to the upside, which would be one way to define a trend. And if you're seeing a 200-day moving upwards, that would be the very definition of an uptrend using that metric. There's lots of different ways to define trends, but that's one way. And as the data falls off, we could see that.
And I'd say, so Russell 2000, I'm going to go ahead and put it in the upward sloping. It's early. I get it. I'm going to call that an upward sloping 200-day.
Oh, yeah, for sure. I think it's been upward sloping basically since the beginning of February. I agree with that.
And the last time we really had this is November 2020. Not saying same market environment comes to fruition.
Well, I do. No, I think that's an interesting thing to talk about because when we think about 2020, well, let me paint this picture for our listeners, right? The COVID crash, and some people tend to forget about it because A, it was so quick. B, there were other things going on in life that definitely trumped it from a priority standpoint, right?
Sure.
When you have a pandemic or a potential pandemic. Now, I'm sure there's many people listening to this. We could have a whole discussion about whether it was or wasn't and our response to it. That's not really where I'm going with this. It's just we had a market correction that was 26 days using something like the S&P 500. It was minus 35%, but yet the rebound was just as historic. And you can go back and listen to our podcast during the time frame as we walk through it and how we handle things for our clients. But my point is, it's really in that 2020 rebound in May through June into September that we start to see thrusts show up.
Mm-hmm.
Meaning your Whaley thrusts and your what's something that's called a 770 thrust. I'm not going to define those here just due to time for today. But we exceed the 200-day moving average. You start to see the 200-day moving average. After those thrusts happen, you retest the 200-day moving average and then move higher. And so isn't it interesting that in January of 2022, you're seeing the Whaley, the breakaway momentum thrust, the 770 thrust show up above a 200-day, and we go back and test the 200-day. Do we get to be surprised if a similar scenario takes place where we test the 200-day and move higher? I don't think we get to be surprised.
No.
We're not calling for that. It's not a prediction. It's just just an interesting scenario that similar to coming out of the 2020 bottom, which was a V bottom, like one of the biggest V bottoms the world's ever seen.
Yeah.
This would be the opposite of a V bottom. You have a 20% price range that goes from May of 21 to March currently. So similar, but different. So we'll see from this point going forward. We've talked about 4180. First, we have to get above 4080. Currently sitting at 4030, 4032. So it's a good step to have a test of the 200-day and hold. Like I think you highlighted something really important. The fact that the Qs and Russell 2000 were retesting their November highs and have so far reacted to them positively. That's information that we should pay attention to.
It is. And it's hard to put the Dow, so the Dow kind of trumped everything, off those.
What do you mean? What do you mean by that? Well, can you describe that for our listeners?
From a technical perspective.
Okay. Like a relative strength perspective?
Yeah. And so when we sit here and talk about November and December highs, well, Dow's November and December highs were actually above its respective August 2022 highs.
That's a good point.
So the Dow is also, shorter term, not as strong as maybe the NASDAQ or the Russell, but longer term, off quote unquote, if October ends up being the low, then you could still argue it's been a relative leader, since the beginning of the year, not so much. But the other two, Russell and NASDAQ, from a technical perspective, looking better than the S&P, I think also bodes really well. And then, of course, we got Europe, which looks better than all of them.
No, this is great that you're walking through this. And just to be clear, for those listening, near term, we would define here at Client First and Adaptive. Near term would be days to weeks. Intermediate term would be weeks to months. And longer term would be months to years. And what Ian is describing is that, yes, from a intermediate term perspective, Dow Jones has been strong, but from a more near term, you are seeing strength out of small caps and Qs. And that's important information. And really, they're important for different purposes. I know if we looked at the Dow Jones, we could talk about one of its largest weighting, United Healthcare.
Oof.
But it's also the Dow Jones Industrial Average.
Mm-hmm.
And I think it's important to highlight industrials.
Industrials have of all shapes and sizes, very strong.
Yeah, and it's kind of across the board in different. What's impressive is the amount of products that we're able to use to express that thesis, because they're not all the same, but across the board industrially, depending on how you depend it, all of them have shown relative strength.
Yeah.
I think of the industrial renaissance ETF by First
Yeah,
Trust,
a lot of the infrastructure things.
or whether you're looking at grid,
Red, yeah.
which is also a First Trust, or you look at PAVE, which is a Global X ETF. All of them have similar characteristics, such as their October lows, October of 22, their September and October lows were higher than their June and July lows. So I want to paint that picture. June and July of 22, you have a price level. The S&P in October exceeds that level to the downside, whereas a lot of industrial slices, whether you use an ETF or an index, didn't cross that threshold. So that's called a divergence. And all we've seen is ongoing strength out of those areas going forward.
XLI was flat for February.
Flat. That's a great point. So going back to the start of the show, we just talked about the S&P being down for the month, and industrials are basically flat. That's relative strength. That's that beach ball under the water scenario where you have downside pressure, but that thing is holding up. And once the market starts moving to the upside, if it does that, you could really start to see industrials move.
I think so. Transports moved to new relative. And so, right, so then you've got all your trucking and underneath, all that. I mean, there's just a lot of, I even think some of the airlines have been, Delta, those types of names are holding up well. Never got below their November and December highs. There's a lot of good things happening out there in industrials.
Yeah, I would agree. And it's interesting, transports, right? You mentioned trucking, whether it's shipping, whether that's on land or sea, air cargo. And this is happening after they've been beaten down pretty bad. And I'll even admit anecdotally, I feel like US plane transportation is kind of and I don't mean this, well, I never intend to be mean, but like I think about flight delays and sitting in airports for 12 hours. I'm not really happy with that. And my hope as a technician is that Price is now forecasting a change in that environment, meaning a return to normally scheduled programming for airline flights. Because right in the past year, I'm betting 80% of the people listening to this have been part of a delayed flight. And I'm sorry, I'm going off on a little bit of soapbox, but I just had experience recently with, and I'm going to name them, FunJet, that was absolutely terrible, where they left us in a foreign country without our luggage. They didn't even know we were coming. So I'm calling them out. And I hope in some way someone from FunJet's listening to this, or Globe X, which was the least company that did it. If jets and airlines overall can get it together and start getting their passengers to where they need to be with their baggage on time, maybe that's what Price is forecasting, and I'm willing to be open to that. And it doesn't hurt from an economically sensitive area. Anytime we're transporting goods, whether it's trucking or shipping or digital goods over semiconductors, because even semiconductors have held up and been strong.
Semiconductors have held up. Back to just aerospace, defense.
Yeah.
Has held up. You've got a lot of machinery names out there. A lot of these building products names out there, like BLDR or
it's a great ticker.
AAON. Yeah, I mean, it's industrials. There's certainly a lot under. You got United Airlines going out to new absolute and relative highs today. Lots of things happening out there.
So sometimes when you're taking in information, some of the important stuff is the stuff that's not said. Notice that we're not talking about staples.
No.
Right? And staples would be a risk-off area. And, whether you're looking now, I'm not saying that they're actually kind of sideways since 2021, but on a relative basis, using something like XLP, they're not in a position of relative strength. And that's important information too. When the risk off areas, I'm not saying that they need to perform poorly, but if they're on a relative basis performing poorly, while these other areas that Ian just described, that's evidence for further equity upside, right? We want to see risk on areas perform well.
Yeah.
What else? What else, Ian? What else are we?
I think under the surface, right? So discretionary has this, Amazon piece that hasn't been really participating. But if you look if you go look at the hotels or the resorts and casinos, and there's a good HOTL, it's a good hotel ETF.
Or beds, BEDZ, yeah.
And look at, just really strong relative strength there.
Yeah, for sure.
Compared to, both BEDZ, HOTL, these are at, solid relative uptrends. I think I mentioned them, but I think there's a lot of these casino names that look really great.
Like a Las Vegas Sands?
Yeah, like a Las Vegas Sands or an MGM or a Wynn or Hyatt Hotels. There's...
Well, and Wynn is such an interesting one because it has such a high correlation to upside markets. Like if you just do I don't want to get in the weeds here, but if you did a study on Wynn and its correlation and the overall market, when Wynn is doing well, the market tends to do well. It's kind of like it's a bellwether is a better way to put it, not a canary in coal mine, but a bellwether stock. It's kind of like a JP Morgan.
I was going to bring JP Morgan up, yeah.
Or a Belgium. I'm not saying they outperform, but when they're doing well, they just have a high correlation to when markets are doing well. That's a great one.
We got a decent bounce out of China this week.
Yeah.
China, obviously, it had a really strong Q4. It had a good start to the year. Rough February, right? That's just high beta.
Yep.
And it would seem to me like if I look at FXI and we look at this 28 to 29 range over, the last 10, 15 years, I like seeing the buyers come in here. If we close like this, the weekly candle on FXI, lots of good things. And I don't think that the February sell-off wasn't too harsh. It kind of just has felt like that we just might be back into an uptrend, and this is more of your typical 5 to 7% correction that you would see.
Right. And to paint a bigger picture, because we kind of already talked about the seasonality that we saw in January, how February is one of the weakest of the 6 months. We do have the trifecta of breath thrusts that happen in January. It's an interesting dynamic when you consider the amount of shorting that was going on in September and October of last year. And we just recorded record short covering in the beginning of February. So it's either one or two things. We've either exhausted the sellers and we are going to move higher because when you exhaust the sellers, all that's left is buying.
Mm-hmm.
Or you've exhausted the sellers and the real correction starts because all shorts are as future buyers. And when people stop shorting, sometimes that's when corrections accelerate. And the beauty is each of those theses, you'll be like, well, what are you talking about? Like you're talking about two different directions. Yes. But what's your game plan? As long as you're above a 200-day moving average, it's now turning up and you start reclaiming 40.80 and 41.80, all that does is confirm the upside thesis. And
yeah, I think you got to start erring on the side that markets go higher.
For sure. So I agree that rather than a V bottom like we saw in 2018 or 2020, this could have been a close to, we'll call it a 10-month bottoming process that had a 20% range. While one of the worst environments for a trend following perspective, it's just the reality of markets. That could be a bottoming process. And it wouldn't match a bottoming process we've seen in 2 decades, meaning, you think about the 2000 bottoming, or the correction, 2000, 2003, the bottoming process, there was a triple bottom.
Triple bottom, yep.
You think about the bottoming process in 08, 09, that's a V bottom type thing. The quick correction that happened in 2011, that's a, rounded bottom, or you could even argue a quadruple bottom.
Yeah.
The bottoming process in 2015 and 2016 was a type of double bottom. You look at the bottom in 2018, V, 2020, V. We haven't seen, if this is a bottoming process, we haven't seen something like this in a while. And that's classic for markets.
And think how many people participating, especially from the retail side, how many people participating in the markets today were here for 2015, 2016?
Yeah. I mean, rare are the Walter Deemers of the world.
Yeah. So, right, you had your December 18. I'd even throw February 2018 in there too.
Oh, for sure.
I know that doesn't get as much attention. I remember that, though. I remember after the year we had in 2017, the lowest volatility year, I believe, on record.
Yes.
They're like no 5% corrections. It was a boring but beautiful year. And that was supposed to be the year that the Orange Man was going to blow something up.
Right. Remember, the market was going to crash in November of 2016.
So we got to 2018, and everyone who had sat out 2017 expecting the world to end was all of a sudden like, holy crap, I just missed out on 25%. And
everybody and their grandma was short volatility.
Yeah, and they right, and we finally, that was the big
Volmageddon. And
that was the trade. If you just short volatility, right? And there were like WAPO and articles in New York Times, and they were interviewing,
and there were entire products that got blown up back in January, February of 2018 based on volatility, because there were so many people and institutions that were short vol. That blows up. And I would make an argument that the market dynamics, since that's an important market mile marker. That's hard to say 10 times in a row. But since January of 2018, you can really make a good argument for the market dynamics changing. Just mean we've been at a heightened volatility since then. And you've had, right, because we average a 20% correction every 4.5 years when we study markets going back in time. And here you had 2018, 2020, and 2022. So you've had 3 in 4. That's different. And you can all pivot back to that 2017 low vol to 2018 low vol blow up through now. And it's kind of interesting that you would have a high vol price movement as a bottoming process. Ian, could you imagine a low vol environment coming out of this? I don't hear anybody talking about that.
Well, all the option traders are going to be really bored
because the premiums would drop.
Also, to a point on our 2018 value line geometric, still 4% below where it was in January 2018.
So the value line geometric, for those listening, that's a way to calculate how the average stock is performing. Is that a good summary?
I think so, yeah.
So you're saying value line geometric index is, say that again, what was it?
So peaked we're 4% below where we were at the 2018 peak.
Wow. I'm going to pause for a second, because you're saying the average stock performance is negative since January 2018. That's
the S&P is up 40%.
Yeah, I'm going to let listeners think about that one for a second, because that's interesting.
So we talk about how rough it's been for the last, sideways since May, or sideways since March 21, which is where we are. Another important date, February, March 2021.
Mm-hmm.
Again, where the average stock started going sideways.
Or down.
But really, the average stock, it's been a crappy 5 years.
Yeah, that's a good point. Well, and that goes back to, from that point, Ian, You mentioned the S&P being up, I believe 40%. So if we do the quick math, that just means that the large cap, the bigger weighted names performed well and carried the index higher while the average stock struggled during that period of time. Would it not now be appropriate that you would see the S&P, I don't want to say struggle, but your large cap names within the S&P struggle and all the stocks underneath the surface returning to a stock picker's market,
Well,
meaning where it matters what you're picking stock selection wise.
we've started off the year with a pretty solid advancement from now Apple. Apple looks fine, but some of these other names, like we mentioned, Amazon, Google, Microsoft back above its 200-day today. But the first two, I mean, I think market's done pretty solid without them.
Yeah.
And you've got IWM on a relative basis back positive today.
Almost where it was in November 22, but a level we haven't seen for a while. And if that moves higher, that's indicative of a market where stocks underneath the surface are performing well. And that goes back to mid caps and
this exact same base from March 2020 through, I mean, this is like if you pull up IWM versus SPX and you go back, I mean, this area it's trying to break above right now is again exactly what we broke above in November 2020.
Right. And it's a significant area that actually goes back to, believe it or not, 2002 was an important high there. It's a price point that if we're moving above that, you could see small caps outperform. This goes back to just the thesis that, yes, you can have large cap or mega cap growth struggle while your mid caps and small caps perform.
Mm-hmm.
This happens. And there's been many points in the recent history where correlations have gone to 1, but it's been the mega caps outperforming, meaning correlations going 1 to the downside during these corrections and the mega caps holding up the best. Wouldn't it be interesting if a new bull leg moving forward, it's the mega caps that struggle, that calm off or cool off, while all these rest of the names, because there's plenty of names, Ian, that we see that are clear skies.
Yes.
Meaning at new highs. So think about that. So I'm going to try to paint this picture for our listener.
And I can't think of any that are mega caps that come to my mind.
Right. There's no big ones that are at new, brand new highs where you've got the S&P basically around its November 22 high, and its all-time high is around 4,800. And that's over a year ago, almost 15 months. And let's call it rounding approximately 18 to 20% to go yet. You have 20% to go before you're at new highs for the S&P, but we're seeing plenty of other stocks that are now hitting new highs, which in fairness, this isn't a recommendation, but I know the Adaptive Select ETF is owning some of those.
Yes.
And that's an important advantage for our clients is clear skies, new skies. That just means you're past where previous sellers had shown up, and that's why it's valuable. Anything.
Yeah, I mean, I'm going through a list of 52-week highs today, and I see nothing that jumps out at me as a mega or even decently. I mean, obviously, United. We've talked about United Airlines. GE is on there. Yes, those are large caps, but this is not large cap tech. It's just not what we have become accustomed to over the last, I don't know, when did the big growth upswing start? Like 2017?
Okay, so when we came out of the 2009 bottom, the area of strength was tech.
Mm-hmm.
And that's carried through for this last decade. And this goes back to recency bias, right? The things that were most recently strong the past decade, as an example, you might get really myopic and only get focused on those things like the Apples and the Googles and the Amazons and the Teslas.
Yeah.
When really maybe we should be looking at the new leaders, right? Because if this is truly going to be a new bull leg higher, there's a different leadership group showing up, and it's not big cap tech.
No,
it's the industrials of the world.
your steels.
Yeah, steel.
Material. I mean, yeah, there's a lot of.
And for some, that's non-sexy, right? Like that doesn't
Who wants
carry
to own Nucor?
Right.
That's lame.
What's the narrative there? How do you tell grandpa at Thanksgiving that you own Nucor?
And not Ethereum.
Right. And so you have a
Nucor also at all-time highs today, just to add to that to the list.
Yeah. So it's just paying attention to where the relative strength is. And if this is we're coming out of a bottom, out of the beauty of coming out of, I'm not saying bottoms are awesome. That just means you went through a correction, which can be hard. But during the bottoming process, you can see where the beach balls that are pushed under the water are that are going to be your leaders going into the next bull leg. And it's not big cap tech. And that's where a lot of eyes are going to be focused. Really, when you look at the information that the relative strength information, it's industrials, it's value, it's small, there's other things that are going to be leading out of this if this is the new a new bull leg.
Agreed.
And that it's the same coming out of the 2003 bottom. That was financials and it was real estate, and it wasn't sexy at the time because it was tech previous to that. And those have harder narratives. And in my opinion, I just think stories get harder when it's about, an airline or an industrial company that no one's heard of before.
Yeah.
It's not as easy as the thing that you hold in your hand every day, an Apple iPhone. It's not an easy narrative.
Or logging on to Netflix.
Right. Or, turn on your TV.
And those are great stories, right? Those are great stories. Microsoft was a great story in the 90s.
Mm-hmm.
And look how long it underperformed for following that.
Right. Amazon. We buy things from there all the time. I don't have a problem with Amazon. But in the end, I'm in the job of making money for my clients when it's time to make money for my clients, and manage risk when it's time to manage risk. And right now, it doesn't appear that Amazon's that place to be to make money. And let's be honest with each other, right? That's why we're in markets. It's not because it's a playground and somewhere fun to be. Markets are hard. You're in them in order to produce return. And this is an environment when short duration is yielding close to 5%.
Yeah. I think that's a very forgotten fact on a lot of people out there, of 5% on what is, as you deemed earlier, about as risk-free as you can get in the world. That's that, in a sideways market after 3-4 years of, like we said, the average stock going nowhere. You don't think that there's people that want to hang out and snag a free 5% lunch?
And that's the hurdle rate, right? If you can own a 1 to 12 month T-bill and yield anywhere from 4.5% to 5% yield, that's your hurdle rate. You now have to justify what you're owning has the potential to exceed 5%. With the I don't know if irony is the right word, Ian, but the majority of the world is probably looking at tech to be that thing when they should be looking at industrials.
Yeah.
So it's a fascinating time. And, I know inverted yield curve is the topic du jour.
It is indeed.
Which is simply just saying that the yield that's paid for things that are, a common one is 2-year versus 10-year yield, that you're getting more yield for a 2-year than you are a 10-year. Now, if we just look at the 90s and 2000s, everybody freaks out and said, well, when we come out of an inverted yield curve, this is when all the recessions happen. But are we really market historians if we're only looking at the 90s and 2000s? Because we see inverted yield curves that go back to 1980. And as far as I know, 1982 to 2000 was one of the best periods in market history. Who knows?
It could see. I mean, and with such a gloomy, overwhelming macro narrative out there.
Yeah.
Wouldn't that just be something?
Well, and this goes back to something you highlighted. And and I believe this would have fallen probably in May and June of 2020, is the market climbs a wall of worry.
It does.
And how many bricks of worry do we have?
So many.
Recession, Ukraine, inflation.
Yeah.
There's some pretty big bricks that are the common talking points of today, that if you're in markets long enough, you see this happen and the market just climbs through those, because the market's a future discounting mechanism. It's looking 6 to 18 months in the future. So it's interesting. Like,
what's one thing you and this would have been Lunch and Learn 20, I think it had to have been early last year, right? So inflation, not always horrible for risk on assets.
right. It doesn't have to be. Like, and I know everybody focuses on precious metals as the inflation hedge, and I'm not convinced of that based on the price data that we see. But yeah, there's areas of the market where, so tech makes intangible things.
Mm-hmm.
Industrials provides tangible things. Is it that out of the question that in an inflationary environment, you would see tangible things outpace intangible things? I don't think that's out of the question. And so, yes,
I think a lot of the strength out of foreign stocks.
Yes.
Well, at least Europe. I mean, right? European finance. I think someone from All Star Charts had a chart this week of European financials. And I mean, look at VGK. These things haven't budged during the rest of the world had a sell-off for 2 or 3 weeks.
Yeah, and Europe just kind of went sideways, yeah. And that was off of a pretty good V bottom. And so,
yeah.
So not all bottoms are the same. You could have a V bottom in Europe while we have a diamond or a pretty big range bottom out of US. That's definitely possible. And how bad are things if European financials are hanging in there?
Probably not horrible. I mean,
you look at something like EUFN.
Yeah.
And it's
Deutsche Bank. I mean,
so we just talked about S&P being 20% away from all-time highs. EUFN, European financials, are only 6%.
Wow.
And so you do have this interesting environment where short duration yield, treasury-wise, T-bills, higher yield than your long duration treasuries. I would make the argument that you're using data, using relative relationships. That's something like iGov. Your international bonds are doing better, which supports the thesis of international financials doing better. And you've highlighted how many times on this show the weighting of international ETFs tend to be financial. I shouldn't say all international ETFs.
Majority of them
are financial.
Yeah, especially in Europe.
And so you have financials holding up internationally, while domestically, domestically, financials a little bit weaker. You use a ratio like XLF, which is typically all US based, is breaking down versus EUFN, which is European financials, which is now breaking a 200-week moving average and some pretty important levels that we haven't seen since 2020, and a rate of trend that goes back to 2014. That's important information. You're going to see strength. You're going to see European financials outpace American financials. I haven't seen that anywhere.
No, not in a long, long time.
Not with Russia and Ukraine. It's just you can't use narratives and CNBC to make your investment decisions. You just can't.
Or you can. I mean, you can.
You can. You technically
can. There you can use anything you want. You can go pick grass up out of your lawn and throw it up and see which way the wind blows, which I would put on the same level as listening to the financial media. Just not something I personally recommend. I think I speak for you there as well, Dave. Why not just pay attention to what's going on?
Yeah. Why not look at
what's happening before your eyes?
Supply and demand, economic law, right? This isn't economic theory. More supply than demand, price drops. More demand than supply, price rises. It's why we study price. This isn't like a theory, like it's a law. That's what happens. It happens at the gas pump. It happens at the grocery store. It happens at the clothing store. It happens in markets. So why ignore law? And I actually think I get why some ignore the law for theory, because sometimes theory sounds sexier, right? Diversify, 60-40.
You can have a lot longer conversations at the cocktail party if you're willing to get into the macro talk.
Right. On why Carvana is the next big thing is a easier story than it is just to say, well, supply is outpacing demand. That's why price is down.
Yeah.
You should see some of the looks I get around my house, Ian, when I bring that up. Dad,
Or
why was it? Dad, why?
You should own some Valvoline. Like what? No Roku, no Fubo, no. I don't know how many of these small cap tech, right? And they're cool, and that's the hard part because I've said this before. We own like 6 Rokus in our house. I get the story behind it.
Yeah, now you're gonna have to you might have to get some ice because those might turn into hockey pucks.
Yeah.
I don't know that for sure because I've got 3 Rokus in my house and I love them.
I love them, except for the remotes are way too sensitive. Every time someone bumps a remote, you get chucked to the home screen.
That's why I always end up on a Bucks game, and I'll be like, "Oh, I'm sorry, babe. I'm sorry, Emily. It's the remote. I don't know what happened. We're watching the Bucks. I don't know. It's the Roku remote."
Bucks are in first place, right?
In the East, and they're like on a 16 gamer.
Wow.
16 game winning streak, I believe. And I'm not even going to try to Google it. I'm just going to throw it out there. I believe the franchise record is 20.
Okay.
Straight wins. But yeah, the first place in the East, dude, they look legit. Like a couple of games they've played without Yanni. And
really?
Yeah. And addition of Jay Crowder and Miles. It's a really interesting group. Like they look legit. So I'm excited. And that's my Roku remote always seems to go to the Bucks right now. I don't know. And we got March Madness coming.
Ooh.
This is a good time of year, right? Because we're about to have what comes
baseball
in
starting. College baseball's already started.
College baseball started. We've got the push for the playoffs in the NBA and hockey. You've got, you just said baseball starting. You've got March Madness. And then we're going to have the NFL draft coming up here, right?
Yeah, I think that's in May now.
So
or April.
We've got a couple months coming up here with some extracurriculars that, it's going to be really interesting. We would never host a March Madness bracket here at Client First because it's illegal. We would never do that. But I'm excited to see what type of thoughts people have on the March Madness.
I threw all my brackets out just like my guns.
Yeah, you can't do that.
Can't have those.
Can't have them. So, Ian, with us running up against the edge of our time, we did, I feel like, do a pretty good job highlighting or painting the picture of domestic, some international areas of strength. We talked a little bit about fixed income or bonds. We didn't talk currencies too much. We could talk about the dollar. The dollar remains above 102, 103.
The dollar hasn't it's flat this week, but nothing notable yet.
Well, I would say the only thing notable about it is since the beginning of February, the trade weighted dollar is up about, let's call it 3.5% to 4% using DXY. Now, typically you see international weakness in that type of environment. And since February 2nd, yes, Europe is flat, but that's notable that you have the dollar up and Europe flat. My point is that's another point of relative strength for those type of areas. China is down. Emerging markets are heavily weighted towards China, but there's definitely areas in emerging markets. Would you have guessed that Argentina
looks great.
Basically, so Argentina is up with the dollar since February 9th. That's something you got to pay attention to, right? Because typically dollar strong, Argentina down. Or you brought up Mexico. Since February 9th.
Mexico. That's you right there. I see that candle right there. That's your family visiting.
Yeah, that's us.
That's you spending your money.
Spending money. Yep. I mean, Mexico's up 8% on a dollar basis. Wow.
Breaking out to new highs today. I mean, this thing is crushing the S&P.
So that is tremendous information because FYI, Mexico's hugely dollar sensitive, meaning when the dollar is strong, Mexico struggles. The fact that the Mexico's up while the dollar's up, you gotta pay attention. That's an important dynamic.
Well, and if you look at the dollar versus the peso, different. I mean, it's getting crushed by the peso.
Yeah, there you go.
No breather.
So rather than looking at the trade weighted dollars, what you're saying is just look at the currency pair, and the dollar's super weak versus the peso. This makes sense. Is that a fair summary?
Yes.
Anything else, Ian, before we wrap this up and put it in a bow and deliver it to our listeners that you want to cover before we get out of here?
No, I mean, Bulls kind of stepped in the last 2 days we had through. It seems, we got a little over an hour till close. Now, kind of everything we've already said. Foreign stocks, got the dollar stalled out. These value, if you're going to be in the U.S., small cap and maybe like a little bit more of a value tilt. Yeah, I think we kind of covered it all.
Right. I think so too. I appreciate it. Everybody listening. If you like this information, you find it valuable, go ahead and give us a high ranking on the platform of your choice. You can share it with your friends and family. We think it's valuable information. We appreciate you guys, both our clients and those who listen. Ian, thank you, and thank you to the Adaptive team.
Have a great weekend, everyone.